Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
So we had somebody come on the channel and basically say that they had bought an FHA loan and they had to move out of the house.
Mm-hmm.
Now, there's a limit on FHA loans. So this is why we're going to talk about this. You can't buy an FHA loan and then rent it out.
Right.
Like you can't buy a house with an FHA loan and immediately turn around and rent out the house.
Right.
Right?
Right.
So let's start with some of the limits on this.
Perfect.
Okay.
So first of all, the amount of the loan varies by county.
Okay, we're just talking about single family houses right now.
So single family houses. So for example, Clark County has one limit.
$494.
Okay. Washoe County, which is also in Nevada, has a different limit. Nye County, different limit, and so on.
And California, some place in California have like 1.2 million.
Right.
Is the limit.
Right, because what they're looking at is they're looking at what homes are selling for in the area, and they're looking to meet the need of that entry level buyer, right?
Right.
Okay, so that's something to keep in mind. So FHA, low down payment, low credit score, and they do require mortgage insurance.
Yep.
And you have to be an owner occupant.
Okay,
now,
so let's talk.
This is where this whole conversation started because, like you said, somebody put a comment in one of the videos saying, hey, I bought a house, I used FHA financing, then I had to move out. Bada bing, bada boom.
3 to 6 months, I think, right?
Right.
Okay, so first of all, what's the minimum time you have to live there?
1 year.
Okay, so after a year, you're completely free to move out and rent the house.
Right. So from when you close on the house until you move in, you have 60 days. It means you can move in the day that you close, all the way up until 60 days. You have to be in there within 60 days.
Right.
And then you have to be in the house for no less than 365 days from when you closed on the house.
Okay, so let's do a scenario then really quick. You buy a house, you move into the house, everything's great, and then wherever your work says, we're promoting you, we're sending you to Austin, Texas. You're going to work in a new job, and you're like, I just bought this house 3 months ago, and I got an FHA loan on it, and I have to be owner occupied. So first of all, I'm going to put this up on the screen so you can just take a look at this. This is the HUD Handbook 4000.1, FHA Single Family Housing Policy Handbook. This thing is 1,400 pages. It's got all the rules for FHA, okay? So everything we're telling you is general information. You can't take any of this to the bank and say, Todd and Juana said. It has to come out of this handbook. And
right.
Times change and this handbook gets amended, but we're telling you is the general rule now. So let's say, for example, Juana, like the person who commented on the video, hey, I had to leave either hardship or I got a job transfer or whatever. What are some things they can, like what can they do?
So they're going to have to contact their lender and let them know what's going on. Their lender is going to maybe ask for some documentation regarding the hardship. And then the lender has a couple choices. They can go ahead and give them an exemption and say, go ahead and move out and rent out the house. Okay. Or their lender can say, don't think so. You're going to have to sell the house because we're not going to continue to allow you to finance the house. Or, I mean, in worst case scenario, the lender can just call the loan if they've already moved out. But obviously, we would prefer that the lender not call the loan. Calling the loan means that the lender wants to be paid within 30 days, that the entire loan paid off because of some default on the part of the buyer. So most lenders are not going to do that. Most lenders are probably going to work with you. Or, a worst case scenario, they would probably want you to sell the house and then they can be made whole and everybody can go their separate ways.
Okay, so let's say you buy the house, you live in it, and then a friend of yours says, hey, I see you have an extra bedroom. Can I rent it for $500 a month for the next year? Because I'm going to be in town for a year.
Absolutely, you can do that. You can rent an unused portion of the house to somebody else, but you cannot rent out the whole house. Okay. The other trick is that you can rent it for 30 days or longer, but you can't do a short-term rental. So like you can't VRBO or Airbnb or something like that, either the whole house or any portion of the house.
For under 30 days.
For under 30 days, yes.
Okay, all right. So here's the last question on this, and we're going to jump to the next one because I think the next one's more fun. What if when you're going to qualify for the loan, let's say it's kind of a really nice house and maybe it's a 3-bedroom, and you tell the lender, I already have 2 roommates. They're each going to pay me $500 a month for the 2 extra rooms, and I want to use that income to qualify toward my income.
Right. So yes, you can do that. You're probably
Single family home.
Oh, it's a single family home.
Single family home.
That's a good question. I know you can do it on a duplex and on a 3-plex and a 4-plex. I don't know that you can do that on a single family home.
You can't do it.
Okay, you cannot do it.
You can't do it. They
Okay.
cannot use the income from a rental, potential rental.
Okay.
Like you can't say, the market rent for a room is $500. I want to get credit for that.
Okay, because I know that you can do it on a duplex, 3-plex, and 4-plex, and you have to provide a copy of the lease agreement and all that good stuff.
Okay, so now we're going to do the next one.
Okay.
The next one is you're looking at buying a multi-unit.
Which would be a duplex, triplex, or 4-plex.
Okay, it has to be one of those 3. It can't be if it's a 8-unit apartment building, you can't buy it with an FHA loan.
So the max is a 4-plex. That's what you have to get focused on.
Okay, and multi-unit just means it's more than one, right?
Yes.
Okay, so let's say that you're going to buy this unit, and it's one ownership unit, but it has separate living compartments. And we'll just say, for sake of argument, we'll start with it's a duplex. And let's say that you're buying the whole thing, but one of the units is already occupied with a tenant. And we'll just say they pay $1,000 a month. And then you want to rent, you're going to buy the whole thing, but you're going to live in the other one. Okay, but you still have to live there. You have to live there for the year or whatever, right? Okay. Do you get to use a portion of that income that is already existing to qualify?
Yes, you get to use a portion of that income. So let's say that you make $5,000 a month. They take a portion of that $1,000 a month in rent that you're going to be getting, and they add it to your income. So, let's say for the sake of argument that they give you a $500 credit. So now it looks like you make $5,500 a month.
Okay. And then if if it's a 3-plex or a 4-plex, it's potentially more income because you have more units.
Correct.
Rented. Why don't they give you the whole, let's say it's a 4-plex, because we did a video on this over a decade ago, and it was a very fun video. Got a ton of people loved the video. And it was a housing hack video because we talked about how you buy one and you get the other 3, and the other 3 basically pay the whole mortgage, right? Because at the time you could do this. Rents were such, and you could buy a 4-plex in Las Vegas 10 years ago. Why don't they give you the full amount? Let's say it's a really nice 4-plex and each unit pays $1,000. Why don't they give you credit for the full $1,000?
So 3 reasons. One, because they do factor in vacancy rates.
Oh, because it's not, someone could move out and it could take you a month to get somebody in, okay?
The second reason, there is rent variability, so market rents could change.
Sure, right. They could go down.
Correct.
Right? They could go up, they go down.
Right. And the third reason is because they do understand that you will have to make some repairs, and that eats into the amount of rent that you're able to collect.
Okay. The percentage on that, a long time ago, it was 75%. It was a set amount. They just gave you, it depends on whatever the current policy is. So don't quote 75%. You do get a portion. It is it's a non unsubstantial portion, meaning it is a decent amount. You get
Correct.
more than, you get a lot of it to count toward your income for the thing. The problem is if the place is already fully vacant.
Right. So, but if the problem is, yes, you have a really good point. If the place is fully vacant, then it is a little bit more of a challenge.
Okay.
But when they do the appraisal on the unit, on the whole property, the appraiser will also state on that appraisal what market rents would be, what the unit is likely to rent for, and that's what they're going to use. So let's say going back to our example, let's say that the appraiser says that you say, well, it'll rent for $1,000 a month, and the appraiser says, well, it'll rent for $900 a month. Then they're going to use the appraiser's number, not your number, because that's what they're going to use. Because remember, we are working with someone else's money, not yours, because someone else is actually loaning you the money to purchase the property.
What's interesting is this, I spent some time, this is really, if you ever want to be completely like exhausted trying to find some information. Remember, this is a government document. This is 1,400 pages, and the problem is just not indexed very well. You can't really find anything in it. So I went through trying to find a bunch of stuff to talk about, and it was really hard to do. But what's in here that's bizarre is that even the very specifics of like the appraiser requirements, like the things they have to take into account, not take into account, and everything from the art when it becomes a bank-owned home, the whole disposition of all the things that have to happen in a specific order, and all the things the title policy have to do. That just kind of gives you an idea of what, like, I have no idea how lenders, like, somehow there's guidelines people are following, but this book was this is a 1,400 page document, the HUD handbook that has all this information in there. And it's not like super, the easiest thing to do is you just go to HUD.gov and you can find some generic stuff. And then maybe, that's a kind of an easy way to do it. But the HUD handbook is updated, and that's the one you need to pay attention to with this.
Right. So do you think that if ChatGPT would have written the handbook, it would have been any shorter?
Yes, it would have been much, because you would have written, if you don't know what ChatGPT, it's an open AI project, but if you put it in ChatGPT, it basically would have probably done the whole thing. And because there's a limit now, it'll only do it in like 12 sentences maybe, the whole thing, the whole handbook. It would have said, it would have been like a 1950s TV commercial, and then that would have been it.
Well, maybe the government needs to invest in that.
Okay, so the bottom line is this. If you're going to buy an FHA house, live in it. Don't try to play the game. I'm told by a lender that FHA is going after people who buy it and then just rent the whole thing out and never live in it. They'll come check. You will get they'll door knock you and say, hey, are you so-and-so? Did whatever? And they can also check to see that you're getting mail there and all that. They do have a way of, it's very difficult now to do this. In the REO days, this is an interesting side topic. Tell them what they used to do when you first bought a Fannie or Freddie property back in the day. The first 30 days in Nevada, what was the requirement?
So I think you're talking about something else, but I'm going to address both those things. So Fannie and Freddie had what was called a 30-day first look in Nevada,
okay,
which meant that in the first 30 days that Fannie Mae or Freddie Mac had a property listed for sale, investors were excluded. They were not allowed to make offers on it, or if they did make an offer on it, their offer was not considered. The only offers that were considered in the first 30 days of the listing during the first look period in Nevada, only owner occupants were considered.
Okay, really quick before we move on. What did Fannie and Freddie actually do after closing on those properties?
So they would check utilities, they would check the mail, and I have heard that they would actually send somebody and knock on the door and say, hey, welcome, Mrs. Smith, to 123 Elm Street. And if you are not Mrs. Smith, then we would like to know.
Okay, so they actually did a physical inspection of the property.
Yeah.
We were doing a lot of these bank-owned homes, and it was during first look. You had to be, if we knew, oh, you're paying cash, and you already have a house.
And you have 15 houses.
You have 15 houses, but you're buying the 16th house. Oh, I promise I'm going to live there. And then we actually had somebody who literally said, I'm definitely not going to live there. I'm going to rent it out. But because I'm signing the document stating I'm going to live there, that's all you as the agent really care about, because you can wash your hands and say, I didn't know they signed the thing. And in that case, we sent a note to the asset manager and said, this is what he told us. He told us he's signing it. But do you remember that?
I do remember that. So when they signed the contract, there was actually a verbiage in there that they were attesting that they would live in there, and that they understood that if they didn't, there was a penalty. The penalty was substantial, actually.
It was really bad, yeah.
It was a percentage of that purchase price, so it wasn't like it was a couple bucks. It was pretty substantial, even though the purchase price wasn't that high. When you're talking about a percentage, not 1%, but a percentage of the purchase price, it was pretty substantial.
Right. So bottom line is, if you're buying an FHA house and you live in the house, don't play this game. But the game you could play is you buy it, you live in it for a year, and then you can go and buy another FHA house a year later as your primary residence. And you can keep accumulating these FHA loans, the advantage being the 3.5% down payment.
Right. So FHA is not the only one that has these types of requirements. We have the first responder program that
Right.
works the same way. The teacher next door
VA.
program works the same way. VA works the same way. So there are lots of programs out there that are designed to give an advantage to an owner occupant over an investor. And we encourage people to use honesty and to use good sense and participate in loan programs for which they honestly qualify.
Yeah.
Okay?
Yeah.
So if you liked the video, if it was interesting, entertaining, if you learned something, fantastic. We're very happy for you. Please like the video, share the video, leave us a note, and tell us what you think. If there is another subject that you'd like us to cover, like this one that somebody suggested, please leave us a comment. We'd like to give it a shot and cover what interests you. If you're new to our channel, welcome. We're happy to have you. Please let us know where you're watching from, and we'll see you on the next video. Bye.
Bye.